everyone, welcome back to our channel. In today's video, we will be discussing average maturity in relation to bonds. We'll go over what average maturity is, how it affects bond investments, and some examples of how to calculate and use average maturity. Average maturity is a measure of the time it takes for a bond's principal to be repaid. It is the weighted average of the maturities of all the bonds in a portfolio or an index. Maturity refers to the date when the bond issuer must repay the principal or the face value of the bond. Average maturity affects bond investments in two main ways. Firstly, it affects the level of risk associated with a bond portfolio. Bonds with longer maturities tend to be riskier than those with shorter maturities. This is because longer-term bonds are exposed to more interest rate risk, which is the risk of changes in interest rates affecting the value of the bond. Secondly, average maturity affects the yield of a bond portfolio. Bonds with longer maturities tend to offer higher yields than those with shorter maturities. This is because investors require higher compensation for the additional risk associated with longer-term bonds. Now, let's look at how to calculate average maturity. To calculate average maturity, you need to first calculate the weight of each bond in the portfolio. The weight of each bond is determined by dividing its market value by the total market value of all the bonds in the portfolio. Then multiply the maturity of each bond by its weight, and add up the results for all the bonds in the portfolio. Finally, divide the total by the total market value of all the bonds in the portfolio to get the average maturity. Average maturity is a useful tool for bond investors. It can help investors assess the risk and yield of a bond portfolio. For example, if an investor is looking for a low-risk portfolio, they may choose a portfolio with a shorter average maturity. On the other hand, if an investor is looking for higher yields, they may choose a portfolio with a longer average maturity. Additionally, average maturity can help investors make informed decisions about the timing of their bond investments. For example, if an investor expects interest rates to rise, they may choose to invest in bonds with shorter maturities to reduce their exposure to interest rate risk. That's all for today's video. Thank you for watching, and please leave your comments and questions below. Don't forget to like and subscribe to our channel for more content.